If you've ever wondered how people actually invest in commercial real estate, beyond just buying a building, you're in the right place. In this episode, we're breaking down the two main routes you can take: direct investment, where you own and manage the property yourself, and indirect investment, where you let professionals do the heavy lifting, often through something called a REIT, or real estate investment trust. Whether you're aiming for full control or passive income, understanding these strategies is key to choosing the right path for your goals, budget, and lifestyle. So grab a coffee, get comfy, and let's dive into the world of commercial property investment. So, let's jump right in. Now, when most people think about investing in commercial property, they imagine owning a building, maybe a high street shop, a block of offices, or even a warehouse. That's what we call direct investment. It's pretty straightforward. You buy the property yourself, you find tenants, manage the lease, and hopefully enjoy both rental income and capital growth over time. This route can be rewarding, especially if you're hands-on and enjoy being in control of your investments. You get to call the shots, choose the property, negotiate the lease, and take full credit when it appreciates in value. But, and it's a big but, it also comes with responsibilities. You're the one dealing with maintenance issues, chasing rent, handling void periods, and keeping up with ever-evolving legal and regulatory requirements. Plus, it usually takes a hefty upfront investment. We're not talking a few £1,000s, think 6 or 7 figures, depending on the type and location of the property. So, what's the alternative? That's where indirect investment comes in. This is ideal if you love the idea of real estate, but don't want the headache of being a landlord. Instead of buying a property outright, you invest in a company or fund that owns commercial properties. One of the most common forms of this is through a REIT, a real estate investment trust. But more on that in a moment. Indirect investment is much more accessible. You can start with a small amount of capital, sometimes even under £1,000, and you don't have to worry about tenant calls at 2 a.m. or keeping up with building codes. It's property investing without the stress. Plus, it offers something that direct investing often doesn't: instant diversification. Your money is spread across multiple properties in different regions and sectors, lowering your risk if one area underperforms. Of course, it's not perfect either. When you go indirect, you give up a bit of control. You're trusting fund managers or company directors to make smart decisions with your money. And like any investment, the returns aren't guaranteed. Property markets rise and fall, and so do dividends. But for many people, especially those just starting out, it's a great way to get exposure to commercial property without needing deep pockets or real estate experience. Alright, now let's zoom in on REITs for a second, because they are probably the most popular way to invest indirectly in property in the UK. REITs are companies that own and operate income-producing real estate, and they are listed on the stock exchange. When you invest in a REIT, you're essentially buying shares in a company that owns a portfolio of properties, maybe office parks, shopping centres, logistics facilities, even student housing. And because they are listed, you can buy or sell your investment just like you would any other stock. What makes REITs really attractive, especially in the UK, is that they are legally required to return at least 90% of their rental profits to shareholders as dividends. So if you're looking for steady income, REITs can be a really solid option. And because you're not the one managing the properties, it's completely passive. There are different types of REITs too. Some focus on specific sectors like healthcare or logistics, while others are more diversified. You can even find REITs that are international, giving you exposure to global markets, if that's something you're interested in. But, and this is important, REITs aren't immune to market swings. Since they are traded on the stock exchange, their prices can be affected by all sorts of things, not just real estate trends, but broader economic shifts, interest rate changes, even political headlines. So while they are great for liquidity and diversification, they are still subject to volatility. A few well-known REITs in the UK include British Land, Landsec, Segro, which focuses on logistics and industrial real estate, and Unite Group, which specialises in student accommodation. You can buy into these through platforms like Hargreaves Lansdown, AJ Bell, or even through your ISA if you want to keep things tax efficient. To wrap things up, let's keep it real. There's no single best strategy. It's about finding what works for you. If you love control and have the time and capital, direct investing could be your lane. If you're looking for a more passive, lower-cost entry point, indirect investing, especially through REITs, can be a powerful and flexible way to build your commercial property portfolio. The good news is, you don't have to choose just one. Many investors use a mix of both, owning a few direct properties while holding REITs in their retirement portfolio. That's the beauty of this space. You can design an investment strategy that fits your lifestyle and long-term goals. Next time on Exinvest, we'll be diving into the world of financing, because no matter what investment route you choose, you'll need a solid plan to fund it. Don't miss it. Until then, and this is the Exinvest podcast, where smart investments start with smarter decisions.